Welcome to the SpreadX weekly financial market preview, joined with Analyst Connor Campbell. We're looking ahead at some stocks announcing this week. So first up, WH Smith.
Yeah, it hasn't been a great year for WH Smith. I think it's down around 14%. It started the year off all-time highs, so it has to be put in that context. I think it was at 7-month lows by mid-April. That's following its half-year results. It's sort of typical for WH Smith. I think the travel division did very well. Total sales are there, up 7%, like-for-likes up 3%, but countered by a poor performance in its high street division like normal. I think that was down 5% for total sales and 4% for like-for-likes. And that led to a 1% decline in pre-tax profit to 82 million. That was sort of the main focus for investors, why the stock has continued to fall lower in the last few months. The stock did sort of try and reassure investors that it was confident in its future. I think it hiked its interim dividend 10% to 16p per share, but that wasn't really enough to get investors back on board. Obviously, since then, you've had which readers vote it the worst high street retailer in the UK. That did a bit of damage. The stock had been sort of recovering after its half-year figures, but that gave it another knock and sort of pulled it back a bit. In terms of its third quarter figures on Wednesday, I think investors are going to want to see, obviously, an improvement in the high street division. Even if we can get its like-for-like sales decline down to like 3%, that'll be seen as significant improvement. And sort of an acceleration in the travel division. I think last year the travel division was posting sort of 9% rise in total sales, 4 or 5% rise in like-for-likes. So a return to those levels, I think, in the second half of the year will be key for WH Smith if it wants to, sort of swing upwards in the second half of the year. In terms of our clients, they're buying around the 1950 mark. Like I said, it started off the year at all-time highs, so there is support for it there. It's maybe pulled back enough now that investors are going to start getting back on board below the £20 mark.
Okay, and then looking at RPC.
Yeah, RPC, plastics packaging company, which obviously is potentially an issue in the next couple of years as more and more companies and governments push to end plastic packaging as the norm. However, its figures actually are fine, given that it's in a sector that might have some issues in the future. Back in March, it said that it was looking for full year revenues to be significantly higher than it was last year. Last year, it came in at 2.75 billion, so that's going to be the key focus for investors, hoping that it can match, the fairly lofty expectations the company has set for itself. In terms of our clients, the stock's been trading between 750 and 825 for most of the year. It hasn't really been able to go either side of that trading bracket. Our clients have been buying as it heads towards the bottom end of that. The bottom end of that bracket. Whether that means it can actually break up above 825 following its full year results on Wednesday is unclear, but there is support for the stock at the bottom end of its trading bracket.
Okay, and then finally, we're going to go with, it's been a bit of discussion about how to pronounce it. We're going with MITIE Group. Yeah,
MITIE Group it's had sort of a turbulent year. I think by mid-March, it was at 13-year lows. Obviously, it's an outsourcing company in a sector with the Caribbean collapse and things like that. Sort of investor support in that sector has been very, very low. But since then, it's bounced back. And in May, I think it was at 5-month highs. Obviously, 5-month highs from 30-month lows. The comparison there isn't great. But, there is, again, it's picked up since its lows. And, investors have come in and bought at the bottom. In terms of I think it's full year figures on Thursday. The company itself had said that it's expecting revenue to be up 2% to, I think, 2.2 billion pounds. However, operating profit is going to be marginally lower, which is a bit of an issue given that the previous year it had fallen 14% to 82 million. Right. So I think investors would have really wanted to see some kind of improvement on that. So it's going to need to be a very, very small drop for MITIE Group, I guess, not to pull back from its recent recovery. I think the other issue was it said that its transformation program, Project Helix, was going to cost, I think, 35 million for the year. That was against the 24 million pounds previously, the previous guidance. So that was another key issue that sort of drove it towards those 13-year lows in mid-March. In terms of our clients, they're fairly mixed about what to do with MITIE at the moment. I think because it's seen the recovery since March as well, that complicates things. Around the 180 mark, there are buyers and sellers. I'd say they're just about erring on the selling side because of how sharp the recovery has been since mid-March.
Yeah. Okay, good stuff. That's all for this week. Thank you very much.
Thanks very much.